What if I told you there's a way to slash your tax bill by 5 or even 6 figures without quitting your day job, without spending 750 hours a year on real estate, and without needing your spouse to do it for you? This is the strategy that's quietly saving doctors, lawyers, tech execs, and consultants hundreds of thousands of dollars every year. And almost nobody is talking about it. I'm Tiffany Phillips, CPA and tax strategist, and today I'm revealing the short-term rental tax strategy that can turn a single property into a massive tax deduction, even if you're a busy professional with a full-time job. If you want to know how high earners are using Airbnbs and vacation rentals to wipe out their W-2 taxes, you need to watch this video all the way through. Let's start with why short-term rentals are treated differently by the IRS. Unlike long-term rentals, which are considered passive investments, short-term rentals require constant attention: marketing, guest communication, cleanings, restocking, check-ins, and checkouts. It's more like running a hotel than being a landlord. Because of this, the IRS treats short-term rentals as active businesses. And here's the magic: active business losses can offset any type of income, including your W-2 wages. The key is the 7-day rule. If your average guest stay is 7 days or less, your rental activity is automatically considered an active business for tax purposes. No need to qualify as a real estate professional, no complicated test, just the 7-day average and you're in. Let me give you a real example. I had a client who bought a vacation rental in a popular mountain town. Most guests stayed 3 or 4 days, some up to 10, but the average across the year was 5.8 days per stay. Because the average was under 7 days, the entire rental operation was treated as an active business. Through cost segregation, we created a $200,000 loss in the first year that completely offset his $180,000 corporate salary. His tax bill went from $54,000 to zero, and the property was cash flow positive, generating over $90,000 in gross rental income. So how do you calculate the average? Take the total number of days rented and divide that by the number of bookings. If you rented for 150 days across 30 bookings, your average stay is 5 days, and that qualifies. You can even influence this by setting minimum stay requirements, adjusting pricing, or marketing to guests who book shorter trips. And just because your property qualifies under the 7-day rule doesn't mean that you're done. You still need to meet the material participation test, but it's much easier than the real estate professional requirements. For short-term rentals, you need to spend at least 100 hours per year on the rental activity and more time than anyone else. That's less than 2 hours per week. Most of my clients easily exceed this just by managing the property themselves. What counts? Guest communication, coordinating cleanings, restocking, marketing, updating listings, bookkeeping, and more. If you're hands-on, you'll hit 100 hours fast. Document everything from day one. Keep a log of your time, take photos, say in emails, and use a spreadsheet or your phone to track activities. The IRS wants contemporaneous records. Don't try to recreate it later. Here's the secret weapon: cost segregation. When you buy a short-term rental, you're normally required to depreciate it over 27.5 years. But with cost segregation, you can accelerate a huge portion of that depreciation into the first year. Short-term rentals are often fully furnished, so you can depreciate furniture, appliances, electronics, artwork, linens, and more over 5 or 7 years. With bonus depreciation, you can deduct 100% of qualifying property in year 1. I had a client who bought a $400,000 short-term rental. The cost segregation study identified $160,000 of personal property for accelerated depreciation. Her total first-year loss was $180,000, enough to wipe out her $200,000 salary and bring her tax bill to zero. And the best part, the property was cash flow positive and appreciated in value. Now, you might be wondering, what happens when I sell the property? Don't I have to pay back all that depreciation? Yes. Depreciation recapture is a consideration, but you have options. Do a like-kind exchange to defer the recapture. Hold the property until death and pass it to your heirs with a stepped-up basis. Remember, you're getting the tax benefit today when you're likely in your highest tax bracket and dealing with the recapture years later when you might be in a lower bracket. To maximize this strategy, choose locations and property tax that attract short-term stays: beach towns, ski resorts, urban business districts near hospitals or universities. Look for properties that require more furnishing and personal property for bigger cost segregation benefits. But Always make sure the property is profitable or at least breaks even on cash flow. I recommend identifying markets you like to own in, then finding properties that work as short-term rentals. For example, a client bought a vacation home in a ski town, uses it a few weeks a year, and rents it out the rest of the time. He gets personal enjoyment, rental income, and massive tax deductions. Here's how to implement this. Identify and purchase the right property. Get a cost segregation study done immediately after purchase. Set up proper bookkeeping and time tracking from day one. Operate the property as a true short-term rental. Don't just let it sit empty. Here's some common mistakes to avoid. Number 1, misunderstanding the 7-day rule. It's the average, not the max. Number 2, not documenting time spent on rental activities. Number 3, treating the property as personal use, not business. Number 4, not charging market rates. Number 5, trying to manipulate this average stay with fake bookings. Don't do this. Operate your short-term rental as a legitimate business. Charge market rates, provide great service, keep detailed records, and treat it with professionalism. The short-term rental strategy is one of the most accessible and powerful tax strategies for high-income earners today. You don't need 750 hours, you don't need your spouse to quit their job, and you don't need dozens of properties. With the 7-day rule, the 100-hour test, and cost segregation, you can create massive first-year deductions, wipe out your W-2 taxes, and build long-term wealth, all while running a profitable business. But knowledge without action is worthless. If this strategy sounds right for you, start researching markets and properties now. The sooner you implement, the sooner you benefit. If you want to dive deeper into short-term rental strategies and other powerful tax savings techniques, grab your copy of my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. If you found this video valuable, hit that like button, subscribe for more tax savings tips, and drop a comment if you have questions about your short-term rental tax strategies or you want to share your own experience. I read every comment and often turn them into future videos. Don't wait until next year. Take action now and start keeping more of what you earn.